Welcome to this Jet Worldwide presentation, Declaring a Value for International Shipping. In this presentation, we review the key aspects for declaring a value for international shipping, and more broadly, the concepts of valuation itself. Along with HS code and the country of origin, value is one of the three main factors used most commonly for calculation of duty. In the majority of cases, the correct value to declare is the transaction value. The transaction value is simply the price paid or payable for the goods. Most customs authorities consider the value for duty to include shipping and insurance, known as the CIF value, cost plus insurance plus freight. Best to specify these three costs on your invoice. If the transaction price is inclusive of shipping and insurance, you should include the term CIF value. The terms value for duty or landed cost often have the same meaning, inclusive of shipping and insurance. In this presentation, we use these terms interchangeably to mean the same thing. In some cases, there is no direct transaction, such as sending samples or warranty parts or a family heirloom. For customs, everything has a value. In such cases, you should first consider the value of identical goods, and if this is not possible, you should declare the value of similar goods. The other valuation methods can get rather complex. If the first options are not possible, best to consult an expert. Note there's a difference between value for duty and value for tax. The value for tax includes duty. This is most relevant in countries with a national tax regime, such as a VAT or GST. In Europe, for example, the value-added tax averages around 20% and can actually have a greater impact on imports than duty. Here's an example. Let's say we're importing goods with a landed cost or CIF value of $1,000, and let's say the duty is $80. The value for tax would assess on $10,080, the sum of the landed cost plus duty. Pretty simple math, but the numbers add up, and as long as we're talking about value, worthy of a mention. Another concept related to value is the de minimis. The term de minimis refers to the value under which goods can import duty-free. It is also referred to as the low-value duty-free threshold. It's most relevant with respect to e-commerce imports and parcels. To the USA, the low-value duty-free threshold, also known as Section 321, is $800 US. To Canada, the duty-free threshold for shipments from the US is 150 Canadian dollars, otherwise it's $20. It's lower to most other countries with different eligibility rules. National taxes such as VAT and GST apply to all imports regardless of value. Note that the de minimis value applies for single orders on a single day. It's per consignment, not per item within the consignment, and you cannot break down an order into smaller low-value shipments to save duty. Also note that not all goods qualify. Some final notes on value: related parties, non-resident imports, and currency conversion. What some consider as a true transaction value may not be acceptable to regulators. Generally speaking, a transaction to a related company or subsidiary complicates things, not just for imports, but also has tax implications. Some countries, including the US and Canada, allow foreign companies to act as the importer of record. These imports may be subject to different valuation rules, often for the reasons we just mentioned. And finally, currency conversion. The transaction value is converted to local currency for import processing. For most countries, the exchange rate, or what's referred to as the prevailing rate, applies to the date of export. Usually month-to-month variations in currency rates are not significant, but again, as long as we're talking about value, worthy of a mention. And there you have it, the basics of valuation. Consult with JET's best-in-class logistics team for rates and project support.